Welcome to Investors Guide. You're watching ET Now. Thank you so much for joining us. I know it becomes more and more difficult with every passing week to talk about your investments given where the market is, but we're here to help you. There's an email ID at the bottom of your screen where you can write to us about any concerns you might have about your investments right now. On the show this week, as the stock market goes from bad to worse, we'll find out why you should stay invested. In our product review, we look at the HDFC Mid-Cap Opportunities Fund and we'll give you a checklist to keep in mind when you're buying health insurance to avoid having your claim rejected. All right, it's time for me to bring in Kumar, the CEO of Value Research and our in-house mutual fund expert, who's been guiding us with our investments over the last 5 years. Thank you so much for joining us again on Investors Guide. Now, we spoke last week about how the market was experiencing severe mood swings. The price of gold had risen sharply, stocks have taken a hit, the rupee sliding constantly. And it only seems that in the last 1 week, things have gotten worse. What a lot of investors want to know now is it going to get even worse from here? Have we hit the bottom finally? And do you expect, and at what point do you expect the market to recover? What is your advice right now for investors who are watching their money dwindle and their savings devalue every day? What's your advice for them?
Let me just come to the point of, how bad can it get and how soon can it recover? And these are two prominent questions which every investor is asking today. It can get bad even from here because, if you look at what we have read in the news over the last 3-4 years, 5 years, that the domestic market is entirely dominated by foreign investors. My sense of the outflow from domestic Indian bond by FIs is that that is one of the biggest driver for dragging our currency, and that can continue because what I feel is that the dynamic for them to invest here in domestic debt has changed completely, and that is for a completely external reason, and we don't have a say in that. Also, there is a reasonable consensus that we are unlikely to witness any significant turnaround, any sharp turnaround. So there could be, a few years of stagnation and some consolidation of the economy for the markets to follow.
But if you think there's more pain to come and you think we're going to see stagflation, then for any investor, myself included, the question automatically is this. Should we then wait for our investments to devalue and lose more value as time to come? Or should we pull out at this point and maybe try and salvage what's already a fairly bad situation?
So I would say that increase your allocation, get a little more conservative. The 10% allocation to fixed income might be it might be desirable today to have 15, 20%, 25%. Just up your allocation and become a little conservative on that front. The other way to deal with it is, the equity component. If you don't fiddle with your allocation, maybe, time to look at investing abroad more seriously. That money will come back at some point when you need it. At the same time, all the returns generated on that money will also be coming back. So there is nothing unpatriotic about investing abroad. And I think people should diversify, people should de-risk, and people should be little opportunistic. I don't think it's time to pack and wind it up or ignore it completely.
But I'm going to ask you about one specific thing that you said, which was increase your exposure to international markets. Now, international mutual funds obviously give us a very good method to do that and a good access to those international markets. But how do we pick? Which fund would you recommend? Would you give us one fund right now that you think would be the best way for a regular investor to add an international exposure to his portfolio?
If I have to suggest some, I would say, the ICICI Prudential blue chip fund, international US blue chip fund is one. I also like the Franklin Templeton's US fund.
All right, 2 international funds on your screen right now. These are the funds that Dhirendra recommends that you add to your portfolio, maybe 1 or 2, just to de-risk yourself from the Indian market that's looking so weak right now. Also, Dhirendra is saying don't panic entirely. It might be a good time to revisit your portfolio, revisit your asset allocation, but pulling out of equity right now altogether might not be the best advice. Well, Dhirendra, we have now a question from one of our viewers. Devesh Rajput has written in. He's 34 years old. He's a very young man. He's just bought a home. Now, he tells us he was investing in mutual funds starting 2006 when he started his SIPs, but he pulled all of that money out and put it towards the down payment of a new home that he's just bought. Now, he says he's going to have to start building his resources again. He has 2 young children, so he's considering his own retirement, his children's future. He has a little bit of money to spare after the money that's going into his EMIs every month. He pays 28,000 rupees as EMI. And what he's done with his spare cash is that he started a recurring deposit, thinking that would be the best way to put money aside at this moment. Now, this brings us back to our fundamental question. When we have home loans that are increasing their rates every day, currently at about 10.5% is, I think, the cheapest loan that you can get in the market right now. Does it make sense for him to be putting money into a recurring deposit on the side?
It doesn't, but it might just be a handy, if he's short of his emergency fund, it might be worthwhile. At the same time, he should consider, accelerated repayment of his home loan, and because this is effectively, his recurring deposit might earn him 8.5%, while he'll be incurring a cost of 10.5% or more on his home loan. So if he can actually increase his EMI, it will translate into either a reduced period for his repayment, or so that I think will certainly be economical.
So, Dhirendra, for someone like Devesh, who's going to be paying off this home loan now for the next 20 years, he also has to start considering his own retirement and his children's future. These are also targets that will come up in the next 20 years. Plus, he's written to us saying he wants to consider buying another property somewhere down the line. How should he prioritize with all of these things right now? Prepaying the home loan, using extra money towards his own retirement, and at what point at all should he consider buying another property?
No, I would say that he should certainly do some kind of estimation that how much money he needs to save for his retirement, how much money is already going by way of his provident fund deduction. So he should have some sense of it. He should also think in terms of his key goals, which is child's education, his retirement, and I think these are not negotiable goals. You must have complete preparedness for these two, and then comes he should keep all those ideas of having the second home and initiating another stream of EMI ahead of these. First, plan for these two, and if both these are actually long-term goals going by his state today, investments going at these points will prove to be very rewarding, because we are talking of 15 years, 20 years. Of course, these are very difficult times to be optimistic, and hold your plan to have the second home, initiating another EMI for another revenue income stream at some point in future, till you are it's not worthwhile to be having another loan.
So Dhirendra is saying that it doesn't make sense right now to consider a second property. What you should be looking at, of course, are your long-term goals, which is your own retirement and your children's future. And I'm going to put on the screen one more time the international funds he recommended a little earlier on the show. If that's something you'd like to consider, of course, you can write back to us if you need anything else. Dhirendra, we have a question next from one of our women investors. Nandini has written in. She's a 53-year-old homemaker, but she does tell us that she was working for 2 years between 2006 and 2007. At that point, to save on tax, she invested 1.6 lakh rupees in 3 tax-saving mutual funds. She's now disappointed with the way they are moving. She's obviously not very happy with the returns that equity is giving her. She put her money in the HDFC Tax Saver, the SBI Tax Advantage Fund, and the SBI Magnum Tax Gain Scheme. She wants to know if she should leave the money in there right now, or should she consider pulling it out. What would you recommend she does?
I would say that money invested in 2006-07 it would not have yielded great return, but at the same time it will not be very disappointing. Of course, these would have been lump sum investment made in the month of March, so one may not have averaged these investments, and those were years in which the market was at a reasonably elevated level. So it may not be rewarding, but they are not disappointing funds. And I would say that if you don't need the money, I think you have done all the waiting. It may not be desirable to moving this money out. Yes, plan your exit from these investments, wait for some more time, opportunistically time your exit.
Dhirendra, if she does time her exit, and then what would you like her to do with that money that she pulls out? Because obviously leaving it in a bank account is not the most efficient thing to do.
53-year-old housewife, and if she needs investment, need any income from investment, park your money in post office MIP. That will get you a recurring income for all times to come and without any anxiety. If this is an investment which you are unlikely to need, but you feel happy about and you can lay your hands on at some point, maybe consider a balanced fund.
All right, so a post office MIP or a balanced fund once you pull that money out of those funds. Welcome back. You're watching Investors Guide in ET Now. Thank you for staying with us. It's time for our product review, and this week we're looking at the HDFC Mid-Cap Opportunities Fund. Avan is here to give us an introduction. Avan.
Thanks for that, Faye. Well, launched in June 2007 as a close-ended fund, the HDFC Mid-Cap Opportunities Fund turned open-ended in 2010. The fund has been among the top 10 performers of its category for every year of its history, except for 2012, when it dropped to number 37 out of 61. The fund has managed to give its investors an annualized return of 8% every year since its launch. Like all mid-cap funds, the HDFC Mid-Cap Opportunities Fund struggled over the last year to navigate our choppy equity markets. The fund has lost 14.3% over the last 3 months, which is lower than its category average and higher than the Sensex or the Nifty. With over 85% of its total corpus invested in mid and small cap stocks, investors will be watching this fund's ability to contain the downside in the current market scenario. Let's put some numbers together to give you a better perspective. If you invested 1,000 rupees in this fund when it launched, you would have 1,545 rupees today. So should this fund be a part of your portfolio? Let's find out. With that, it's back to you, Faye.
All right, Avan, thanks for that information. Dhirendra, HDFC Mid-Cap Opportunities, like a lot of the other mid-cap funds in the market, has taken a serious beating over the last 6 months or so. But even among its category, it's slipped to number 47 over the last 6 months, to number 61 in the last 3 months in terms of returns. Should we be looking at its short-term returns at all, or do you think its long-term track record should give us faith at this point?
No, I think, these brief period actually don't matter, because if you look at, all the 5-year, 3-year, or a little longer period or year-on-year basis, if you look at it, it has been among the good performing funds. Don't look at 3-month performance, 6-month performance, that too in a market like this, and that too in a mid-cap fund. I think the scale of the fund, the size of the fund, and the kind of stability it shows, and the way it has been doing well on an annual basis since its start. I think a mid-cap fund, one must hold it through a full market cycle. It has just been through, it has been through with one. But I don't think, most investors who came into this fund has experienced that or has been through a full market cycle. So I would say time to evaluate will be at least a modest bull phase of the market. And till then, carry on with your investments. If you are on a SIP plan, carry on, keep at it, be at it. Or if you have your investments made into this fund and you're holding it and you're getting impatient, don't get impatient. This is not a fund to get impatient in this kind of market.
Well, Dhirendra, if you're holding on to this fund, I also want you to speak to all investors right now who have mid-cap funds in their portfolios, are possibly getting very, very nervous. How should we rate the performance of our mid-cap fund? Should we be comparing it perhaps to an HDFC Mid-Cap Opportunities, see how it's doing? Or would you recommend that we just wait out this cycle and see how these funds recover when the market does recover?
Of course, wait out for the cycle. But I would say that, look for any fund which is in the bottom quartile on a year-on-year basis for 3 years, and I think you can call it quits. Look at the rating. 3-star and below could be a good starting point, 2-star and 1-star, because in a methodical way, on a 3-year basis, if a fund is doing poorly and it is doing with great volatility, that will get phased out on the rating scale itself.
All right, Dhirendra, finally, give us your rating of the HDFC Mid-Cap Opportunities Fund. Where would you place it?
I'll give it a 4-star for its relative, for its little struggle in recent times, but it remains an attractive fund.
4 stars for the HDFC Mid-Cap Opportunities Fund on Investors Guide. Remember, Dhirendra said if you have a mid-cap fund right now, especially this fund, it makes sense to give it an entire market cycle before you lose heart. Mid-cap funds tend to get beaten down the most when the markets are weak. It's time to move on to our hold or sell segment. 27-year-old Gaurang has invested in a few mutual funds, Dhirendra. He's very young. He tells us he has no particular liability right now. He's putting money aside. He'd be glad to increase this amount that he's investing a little bit as well. So he wants to know if these funds that he's invested in are the best funds for a long-term view. Right on top is the IDFC Premier Equity Fund, 6,000 rupees. So his largest allocation is to this fund. Are you happy with that? Should he continue investing in that fund?
I think it's an impressive fund. This is a fund where you should have a larger allocation, and he has one. So continue investing.
For the next two funds I want to take together, he has the HDFC Equity Fund and the HDFC Mid Cap Fund. Should he continue investing in both of these funds, Dhirendra, or can he consolidate that money?
I think, if he's investing for next 10, 15, 20 years, he's 27-year-old, then he can do without the HDFC Equity Fund. It's about 40-45% into large cap, and remaining one can say that it's a HDFC mid cap opportunity is also very much a part of HDFC equity. So he should be, if he's willing to take chances, HDFC mid cap opportunity might be a desirable thing without the undue risk, because it has kept it's a very well managed portfolio and not a very widespread thing. About 60-65 stocks make the whole portfolio, which looks more promising to me at this point.
Well, the next on his list is the ICICI Discovery Fund, Dhirendra. 4,000 rupees going into this fund every month. Continue that investment as well.
ICICI Discovery Fund will be a very nice complementary investment to this. It's a value fund, does well. Like every fund, at this point it looks like a struggle, but it adds a very desirable dimension to the portfolio.
And last on his list, the Birla Sun Life Gen Next Fund, Dhirendra. Continue this investment as well.
This is a kind of fund which I generally dislike, but it's a slightly broad-based. You can say that it's an FMCG fund, but not a pure FMCG fund. Though this fund has done very well, it will be desirable to move his money into something which is broader mandate. Maybe Birla Sun Life Mid Cap, or the earlier three fund could be a good. He can spread the money which he will be discontinuing in Birla Gen Next into these three funds. And it may not be a bad time to be doing that, because Birla Gen Next has done very well.
And finally, Dhirendra, if he can increase his allocation right now, would you just recommend that he moves the money into the funds that you recommend he holds on to?
Yes, I would say that he should move his money to. He has, these three funds combined together make a very good portfolio. The only missing element is the large cap component, but given his time frame, he can do without one. And IDFC Premier Equity and one more diverse or a small allocation to a large cap fund might provide him the desired stability.
All right, Gaurang, we hope that helps. Remember, you can reach us if you have any more questions about your money. If you have questions for Dhirendra Kumar, email ID is at the bottom of your screen. Feel free to write to us. Dhirendra, thank you so much for spending time with us this week and answering all of our questions. All right, welcome back. You're watching Investors Guide on ET Now. Thank you for staying with us. We're going to take our eye off the market for a little while and talk about the other products that we should be focusing on. For example, health insurance. We have Anil Sehgal who joins us now to answer all of your questions on insurance. Anil, thank you so much for joining us. Our first question comes in from 36-year-old Shafali. Now, she tells us she hopes to buy a health insurance cover of 15 lakh rupees, but both she and her husband approached Apollo Munich Health, and their proposals were declined due to risky medical conditions. She wants to know which company will now give them an insurance policy, and is it going to cost her more than she expected? Anil.
Shafali, is very good that you have cover already provided to you by your company. So that means that any risks are immediately covered. It is also good that in your test with Apollo Munich, they have indicated to you what the medical conditions are that you need to get treated for, and you're taking treatment for them. So the first thing obviously is to make sure that the treatment continues, and you can deal with any of the issues which have been highlighted in the medical report. There are two things to consider here. One is obviously that once your treatment is complete and you see that the risks which were existing are no longer there, then you could reapply. Having said which, there are slight differences between insurance companies in the way they look at risks from time to time. And it is quite possible, not knowing the details of the medical condition which got reported in your case, Not knowing that, even then I would say that sometimes it is possible that one insurer could decline a policy and another insurer might accept the same risk with a higher, shall we say, rating, where the premiums are increased. So in case you need to have cover ASAP, then I would suggest you could look at another insurer, or else continue your treatment and then go back to the insurer of your choice and reapply with the revised medical reports.
Our next question comes in from Prajot, who wants to consolidate his wife's, his mother's and his own health insurance plan in a family floater cover. He wants to know which plan he should choose at this point. Anil.
Yes, you could consider a family floater plan because it gives you the higher cover and between the two of you. However, please consider that when you surrender your existing plans, then you might lose any existing benefits that you might have, for example, a no claim bonus or your eligibility for the waiting periods that might have already passed since the time that you took the plans. So any new plan that you have will come with its own waiting periods, and that is something that you should consider. Now, a kind of top-up plan is a good option also because it allows you to continue your existing plans and allows you to increase the total cover that you can have. So in that sense, a top-up plan might work for the two of you as well. Having said which, the ultimate decision on which is the option to take depends on what are the kind of the benefits that you are looking for from your plans, whether you're looking for OPD cover or not, what is the maximum age to which you're looking to be covered, and so on and so forth. So the first thing to do is to really determine what are the options available and what are the options that meet your requirements, and then decide which plans suit your requirements, and then take a decision accordingly. The same applies to your question about your mother's plan. The good family floater plans that you could look for are the Max Bupa Heartbeat, the Apollo Munich Easy Health, the L&T MediPrime and the Reliance Healthcare plan. So these are 4 plans that you could consider, but look at the features in detail and then decide.
Now, while buying a health insurance cover or making a renewal, we often make some very common mistakes. We ask the agent to fill up the form. We don't really read in the fine print, and a lot of times that comes back to hurt you when you make your claim. Here's a checklist of what you should keep in mind when you're buying a health insurance cover. Take a look.
India currently has over 83 health insurance policies available in this market. Each of these plans has specific cover and exclusions, different conditions and different premium payment options. Choosing a health policy can sometimes feel like it's injurious to your health. But if you make short work of this process, you might miss out on important details that will come in the way of your claim in the future. Here's a list of things to keep in mind when you buy a policy. First, read through all the exclusions very carefully. Several policies have limits on the amount they will pay for certain procedures and exclude some ailments altogether. Make sure you have fully understood the extent of the coverage offered. Look through the list of hospitals included in the cashless scheme for this policy and make sure the hospital of your preference is a part of that list. Third, if you plan on expanding your family in the future, make sure you buy a policy that covers maternity expenses and newborn babies. Fourth, buy a policy that will cover you for the longest term possible. Policies that stop coverage at 55 or 60 will leave you vulnerable at the time you need it most. And finally, buy a policy that will cover all your existing ailments. Most policies will include a waiting period for a year or 2, but ensure your ailments will all eventually be covered. Now that you have found your policy, here's a list of common mistakes that customers make that lead to rejected claims. First, disclose all your old and existing ailments when you sign up for a policy, even if you have been treated and are no longer suffering from that problem. Second, never sign a blank form. Your agent may be unaware of certain details related to you. If the policy is underwritten with incorrect details, this could mislead the insurance company and give it reason to reject your claim in the future. And finally, if you consume alcohol or tobacco, be honest about your habits, even if it increases your premium.
Alright, so if you have any questions about your insurance policies or your investments, you can write to us. Email ID is at the bottom of your screen. You'll find a copy of this show on our Facebook page, and you can reach me personally on Twitter. Anil, thank you so much for joining us. Tune in next week to catch Investor's Guide. Thanks for watching.